Hello and welcome to the Tax Roundup for September 2014. And while the politicians have been busy negotiating the passage of the budget measures through Parliament, the ATO have been active clarifying their views in a number of really important areas. But speaking of the ATO, if you think it's only a matter of time before your clients are targeted by the ATO and other regulators for audit and investigation, then you need to have a look at Accountancy Insurance's Audit Shield. Audit Shield protects your clients and your practice against the cost of audit and investigation by the regulators. A while back, Hayes Knight made the decision to implement Audit Shield into our practice, and we're just suggesting that if it isn't something you've looked at as yet, you just have a look and see whether it's valuable to your client base. You can give them a call on 1300 650 758 or see accountancyinsurance.com.au. From the ATO this month, Ray looks at an issue of interest to predominantly temporary residents, the tax treatment of interest paid on unclaimed superannuation amounts.
We'd just like to revisit departing Australia superannuation payments. These are the payments of superannuation benefits that are made to former temporary residents who've permanently departed Australia and their visa has been cancelled. So for example, somebody's come here either on a backpacker visa for a couple of months, or maybe an executive who's been here for 2 or 3 years. They've left Australia, they're not coming back, immigration knows that and can confirm that to the ATO, they can get their superannuation benefits back. Unfortunately, there is a catch, a tax catch. There is a high tax rate of withholding in relation to departing Australia superannuation benefits. 0% if it's tax-free, 35% if it's taxed, 45% if it's untaxed. So you add that to the original 15% contributions tax, it's quite a hit on their superannuation benefits. They can get it back once they permanently departed, but the ATO have come out and clarified 2 things. One, if a former temporary resident is now dead, the same withholding rules still apply. If that former temporary resident is now an Australian resident, a permanent resident, their visa maybe is no longer going to be temporary because they're here permanently, in that case, they can still have their benefits rolled over to another fund. Any interest payments that we made in relation to their superannuation fund from the 1st of July 2013 will be tax-free. So at least there's something in it for them.
There have been a series of important rulings and determinations from the ATO this month. First up, Michael Carruthers looks at a really important issue of what happens when a company transfers money or assets to comply with an order under the Family Law Act.
But when it comes to transfers of assets out of private companies to individuals as a result of marriage breakdown, the ATO hasn't budged on their position. TR 2014/5 finalises a draft ruling that was issued a little bit earlier by the ATO dealing with the situation with what happens when an asset is required to be transferred out of a private company to someone who is either a shareholder or a relative of a shareholder of the company. Does that trigger a tax obligation for the recipient of the asset? And what we're looking at here is where that transfer has been required because of a court order, family law court order. And what the ATO says is that if that asset is being transferred directly to a shareholder of the company, then we don't even have to worry about Division 7A because that will just be treated as a dividend, a straight dividend for tax purposes. The value of the asset would essentially be the amount of the dividend that needs to go into the recipient's tax return. If the recipient is not actually a shareholder of the company but is a relative of the shareholder, then we're into Division 7A territory. So even though it's not an ordinary dividend, it would be treated as a dividend for Division 7A purposes on the basis that it would represent a payment as defined under the Division 7A rules. The other thing that the ATO does note though is that either that ordinary dividend paid to the shareholder or the deemed dividend that might arise under Division 7A, franking credits can be attached to those. So the tax impact for the recipient can be minimised, mitigated a little bit, but it's really important for practitioners to be aware that there is this potential tax impact for the recipient, and certainly in the past there's been some views that in some cases you might be able to get around that. You might be able to rely on some exemptions within Division 7A to avoid that dividend being triggered for tax purposes, but the ATO is saying that's not possible. They don't believe that that exemption can apply, so the recipient will normally have a tax impact they need to deal with personally.
Have you ever wondered about the tax treatment of all those credit card surcharges when you buy something? No? Well, you're probably not alone. A recent GST ruling from the ATO on ATM fees and credit card surcharges might surprise you. Michael explains.
Now, the ATO has released some draft guidance in the form of a draft GST ruling that deals with the GST treatment of fees and charges that might be triggered when someone either takes money out of an ATM or uses a card, a debit card or a credit card, to access a payment facility. Now, while we're probably not so worried about the GST treatment on ATM fees, the one that would be most relevant to a lot of our clients would be what happens when they allow someone to pay for goods or services using a debit card or a credit card, and they charge a surcharge on that transaction. Now, the ATO says that basically that surcharge that applies to the debit or the credit card transaction would be treated in the same way as the underlying transaction. So if someone comes into the store and buys some goods, and those goods are effectively being sold as a taxable supply, so that the sale of those goods is subject to GST, then GST will also apply to the debit card or credit card surcharge that might be applicable. The ATO also discusses what happens when a customer comes into a store, buys some goods or services, or maybe just comes in and asks to withdraw cash using the merchant's EFTPOS facility. Now again, the ATO says in most cases that will trigger a GST liability. So just important for clients, the dollars involved are probably little for each transaction, but need to get it right because these things, little things do add up over time. So again, just general rule, debit and credit card surcharge fees normally take the same character as the underlying transaction. What is the GST treatment for the goods and the services that are being sold?
Virtual currencies such as Bitcoin have been the subject of scrutiny from the ATO. Mike looks at the series of determinations and rulings released from the ATO that will not impress proponents.
Now, there's been a bit of media attention this month, particularly around the GST treatment and the FBT treatment, income tax treatment of Bitcoin. For those of you who've got absolutely no idea what Bitcoin is, it's very difficult to explain, but think of it in terms of maybe a virtual currency. But this is where it gets confusing, is because the crux of the ATO's position on this is that Bitcoin is not a currency. It's not Australian currency, and it's not foreign currency either. It's effectively an asset in its own right that people use to swap for other assets or other goods and services. So from the ATO's point of view, they're basically treating it a lot like a barter transaction. So you have this Bitcoin, you are trading it, giving it up for some other goods and services. And what the ATO is saying is that there could be tax implications on you if you use Bitcoin to pay for some goods or services, because it's not dollars and cents, it's not Australian currency. Now, this will be much more relevant to taxpayers who are trading in Bitcoin or who might be carrying on a business in their own right and are using Bitcoin to either buy or sell goods and services. Much less relevant for someone who's a private individual, not carrying on any sort of business or enterprise, and are using Bitcoin to pay for private purchases or domestic purchases. Generally, they won't experience any real tax impact on that. But basically what the ATO is saying is you're giving away an asset. So if your Bitcoin cost you $10,000 or less, and it's not a business transaction, then generally you won't have to deal with tax issues. If the Bitcoin cost you more than $10,000, you might actually have some CGT issues you need to deal with, because the value of Bitcoin can fluctuate. So you would need to potentially take into account a capital gain or loss that would bring into account some tax impacts for you between when you acquired the Bitcoin and when you used it to buy some goods or services. Again, much more relevant from a GST point of view as well, where the entity that is using the Bitcoin is registered for GST, because that can be a taxable supply as well. So there could be GST implications, GST liabilities triggered, and on the other side, it could be actually input tax credits to claim back where someone has used Bitcoin to acquire goods or services. So again, we need to think of it in terms of a barter transaction, an asset being swapped for other goods or services, and that really will help us get around at least what the ATO's view is on Bitcoin transactions.
Finally, in cases this month, Ray looks at a decision impact statement released from the ATO, grudgingly accepting the outcome of the Dempsey residency case, and it comes with a warning about anyone looking to use the case for their own purposes.
The ATO have issued a decision impact statement in relation to the Dempsey case, which was covered in the July tax roundup. As you may recall, that revolved around a taxpayer who was domiciled in Australia, had a home available to him, was coming and going and visiting on not too infrequent a basis, but actually lived overseas. In that particular case, the AAT held that the taxpayer was not a tax resident of Australia for the 2 years in question. The ATO initially were not particularly happy with that view, but they've come out now with a decision impact statement and said that they agree with the AAT's approach in this particular case, based on these particular facts and circumstances, and the taxpayer they've held is now a non-resident of Australia for those 2 years. However, they have stated no new law has been created based on this particular case with these facts and circumstances. As we know, a small change in the facts and circumstances can have a very, very big impact on the residency of a taxpayer, which obviously impacts the scope of their Australian taxation and can have a very different answer.
Speaking of residency, if you want to make sure you can identify and work through cross-border issues for your clients, regardless of their needs or entity type, then be a part of the cross-border workshop. It starts in October. Now, the early bird ends on the 10th of September, so be quick and don't miss out. But that's the tax roundup for September 2014. Remember, if you're not a part of Knowledge Shop as yet and you want access to a help desk, work papers, PD, and a whole range of other things, then give us a call on 1800 800 232 or have a look at the website knowledgeshop.com.au. See you next month.